For the first time in about a month, mortgage rates moved up week over week. Does that mean the downtrend is over and we're about ready to see a spike, or do we have good news ahead? If you're a home buyer, if you're looking to refinance, if you're a real estate professional representing buyers or sellers in the current market and you want to see what happened this week and what's likely to come next for rates, join us as we go through all the news you need to know. So let's jump in here and look. The 10-year Treasury ended the week just about where we started. You can see we made a little run from 424 down to about 415 and ended up right back at around 424. That's up from where we ended up at 4.17 or so on the 10-year at the end of last week, looking like we might make a run through that important level of resistance in that 418, 419 range. As far as mortgage-backed securities, we basically treaded water the first part of the week, and then the last couple of days here, Thursday and Friday, saw rates get worse. That's that red line on the right side of the screen where you see prices for mortgage bonds going down. It means interest rates go up. Well, let's look at what actually happened to move rates. So on Monday, we talked about, we closed last week at about 418 and we opened at about 423, 424 this week. There was some market reaction to the assassination attempt on President Trump last week. Anytime you see global uncertainty in politics, geopolitics, you're going to see a move. It was brief, muted, didn't make that much of an impact. On Tuesday, we had stronger retail sales. On the headline, it was about as expected, but the underlying data, when you exclude autos and gas, we were up 0.8% month over month versus expectations of 0.1 month over month. Sounds paradoxical, but that's bad for interest rates when we see a strong consumer leading markets to think that the economy is strong going forward. Wednesday, we had housing starts, industrial production. Again, not really a market mover, not big data. Thursday, not a lot of data. Weekly jobless claims, we saw them at 243,000 week over week versus expectations of 230,000 new claims for the week. The important thing about that is the week that actually is used in the establishment survey going forward for next month's non-farm payrolls. It generally portends a worse jobs report, that is one of the things that the Fed is looking at when they're deciding when and how much to lower interest rates. Today, we again saw some weakness in bonds, not really any reason for it. We had more corporate bond issuance than typical, about $50 billion today. And when the market absorbs that, you often see treasuries and mortgage backs selling off. We did see that. Other than that, just low trading volume. So you see bigger moves. But overall, a slow week. In the big picture, this movement that we're looking at here, it's from top to bottom was less than 1/8% in mortgage rates, less than 1/8% in treasury yields. So some movement. People get worried when they see the end, or what they worry to be the end of improvement in rates, but really just sideways movement on the week. This is the bigger chart we want to look at, bigger picture. That green down channel in 10-year treasury yields, which mortgages will follow closely, is important. I threw the orange line in there because with all of this backup over the last 2 days, we're right there at that 424, 425 level. As long as we stay below that, we are still likely to visit the bottom of this channel somewhere around 4.07 on the 10-year yield. If for any reason that gives way, I would guess we're going to make a run up to that green line, which is going to be 1/8 or so worse in interest rates. So big picture, worst case would be 1/8% worsening if we were to breach that level. If we continue to see the downtrend, we at least have another 1/8 of improvement ahead of us. What is next? What will move the market next week? On Wednesday, we have the S&P Global Services PMI. Services have been the key cause of inflation versus goods over the last year or two. So it's an important read, but not as important as what we're going to see on Thursday. We get the first look. They revise it 2 more times of second quarter GDP. Prior, the first quarter, we were at 1.4. It's forecast at 2.0, which is an interesting forecast because everyone's expectation going forward is that we're going to see GDP in the 1 to 1.5% range. So I'm not sure why we would see 2%, but it's a fairly reverse engineerable number. So we'd expect it to be somewhere near that forecast of 2%. The big one, Friday next week, PCE inflation. That is the Fed's preferred measure of inflation. Last month, we were at 0.1. Currently, it's forecast at 0.2, but let's take a look at that because that could be the market mover this week. This is the Cleveland Fed's nowcast of inflation. They look at it month over month. They look at it year over year. So they are expecting basically 0 month over month inflation in the core and headline PCE number. And with that, they are expecting to see a 2.4 core PCE rate and headline PCE rate. So we're getting really, really close to the Fed's 2% inflation rate. And month after month, it's another brick in the wall of them getting convinced that we are moving sustainably towards 2% where they want to be, and we're likely to start seeing Fed cuts. We're seeing expectations for the September meeting at like 97% chance of a Fed cut with a 4 or 5% chance of a 50 basis point cut. So at this point, almost baked into the cake unless we get some surprising news that we're going to get that cut and a really low PCE number. We see we have a 0.3 falling off last month. So last June was 0.3. If a 0 comes on, it'll actually take us down to about 2.3, which is a little bit better than that Cleveland Fed nowcast. If we get better than expected inflation, it will really be the final sort of fact that will push us likely towards a Fed cut. The important thing to know is at this point, mortgage rates, the market have priced that in at this point. So I don't think we're going to see a huge movement until the market starts getting convinced that November and December are absolutely in play. And we're more than the 55, 60% odds of November and December cuts after the election. So what does that mean actually for interest rates? 30-year fixed, well below 7%. We always like to look at Mortgage News Daily of all the published online numbers. They're the most accurate. For a well-qualified borrower, high credit scores, big down payments, it's going to be better than that. If you have a low credit score, small down payment, could be a little bit worse. FHA and VA, they're reporting 6.3. For well-qualified borrowers, 6.25, super reasonable. We've locked a few this week in the 5s. So again, seeing some really good numbers from that perspective. If you watch the weekly update and you have questions about mortgages, if you'd like to get a quote on a mortgage, if you have a quote and you'd like to get a second opinion to make sure that what you have is in line with where the market is and there's not some money to be saved or a better loan structure for you, reach out. I would love to talk to you. All of my contact info is in the description below. My name is Josh Lewis. I'm a certified mortgage consultant. I've done this for 29 years and I would love to help you.